Japanese candlesticks. Alright, welcome to the third part of this lecture, Japanese candlesticks. And what we're going to do now is talk about a charting method, a method of analysis, of technical analysis, called Japanese candlesticks. Chances are you've probably heard of it. We did talk about candlesticks when we talked about constructing charts at the very beginning of the course. Now we're going to actually look at what kind of patterns can we find from these charts. Alright, so the main thing to know about Japanese candlesticks is that they are a charting method, first of all, which depict the open, close, high, and low for each day. That's for a daily chart. It can be for any time period. If it's a weekly chart, it'll be the open, close, high, and low for the week, etc. Now usually if we see a light colored or a green colored candlestick, this indicates a rise in the market. This means that the open was below the close. And if we see a dark or a red colored candlestick, it indicates a fall in the market. This indicates that the open was above the close. And then at the end of each, above the open and close, we'll see single lines moving up or down, and that indicates the high and the low. Now if you can't picture it, that's okay. When we do go through some pattern examples, you'll see what it looks like and what they mean. Now, what is Japanese candlesticks? What do we use it for? Well, a certain combination of candlesticks can be used to forecast market movements. So we can look at the candlestick patterns and use that to forecast what will happen next, right? So it's really just technical analysis, but instead of using a line on a chart and drawing a trend line, for example, we're going to be using candlesticks. We're going to be looking at the colors of the candlesticks and the positioning of them in order to make inference. Now the forecasts usually fall into either one of two patterns. This will be either reversal patterns or continuation patterns. Right, so every time we see a Japanese candlestick pattern, it's either going to signal a reversal in the trend or a continuation of the trend. With Japanese candlesticks, reversal patterns tend to be more common than continuation patterns. Now the most important thing to be aware of whenever we use Japanese candlesticks is that, as I mentioned, they're either going to be reversal patterns or continuation patterns. So what does this mean? Well, it means that in order for a reversal or continuation to take place, there needs to be a prior trend. So before we even use it, we need to be aware of the current trend. Right? So if we're talking about a reversal, it's a reversal of the current trend. So first we would identify the prior trend, okay? And then we would use Japanese candlesticks to determine whether a reversal or continuation is going to take place. So now for the rest of this segment on Japanese candlesticks, we will go through some candlestick patterns. These are some of the common ones. There are many out there, so if you're interested, you can look up in the reference that we've mentioned in the Murphy book, which gives you a lot more different ones. And as well as online, you can get a lot of different ones as well. But we'll just go through some of the most important ones. Reversal patterns. Dark cloud cover. Before we go on to discuss this pattern, I just want to make sure that we understand what a Japanese candlestick looks like. So let's just go quickly down to this picture here. So here we have a light colored candlestick and a dark colored candlestick. So a light colored candlestick means that the market rose, so then the open will be below the close. So this line here indicates the open. This line up here indicates the close. And the bottom point here indicates the low. And this one indicates the high. Okay, and for this one, this is a dark one or red one, so the market fell. So this means we opened up here, we closed below down here, and this again is the high, and that's the low. Alright, so that's how we read a Japanese candlestick, in case you were not aware. It's pretty straightforward. It's nice to look at candlestick patterns because it gives us a lot more information than simply connecting closing prices together. Okay. Alright, let's now talk about the first reversal pattern, which is the dark cloud cover. So this pattern here is a dark cloud cover. Now following an uptrend, so I have these three lines here. This is my uptrend. This means that these could be any candlesticks. I've just drawn them black. It means they could be dark or light, but we have an uptrend, so the candlesticks are moving up. Chances are they will be light then. So we have, following an uptrend, we have a long light candlestick. That's this one over here. Okay, and the following day, right, we have an open that is above the close of the previous day, right? So the close was here the previous day, right? And the open is above the close of the previous day. That's a bullish sign. But after that open, trading for the rest of the day is lower, right? So the market makes a high here, but mostly goes down lower. It goes all the way down here. And it closes below the midpoint of the prior day's body. Right? So the prior day's body is this square here. The midpoint is around here. Maybe lower here actually. And sorry about that. It's lower here. And the close is below this midpoint, right? So the close is down here, well below this midpoint. And this becomes a bearish signal, right? This close quite below this midpoint causes people to leave the market, and this leads to a reversal in the trend. So this is a reversal pattern called the dark cloud cover, and when we see this pattern, it means that the trend is likely to reverse. Reversal patterns, piercing line. The next reversal pattern we'll talk about is known as the piercing line. The piercing line essentially is the exact opposite of the dark cloud cover. So how does it work? Well, following a downtrend, so we're starting with a downtrend, that's signified by these three lines here. Again, this just means that we have a downtrend. These candles could be anything. Following a downtrend, we have a long dark candlestick. That is this candlestick here. Okay, this long dark candlestick. And the following day, so this day, we open below the close of the previous day. So the close of the previous day is here, and we open here, which is below the close of the previous day, right? That again is our bearish signal. And then we make a low here, but then trading for the rest of the day is higher. So we go all the way up here, we make the high up here, and we close above the midpoint of the prior day's body. So this here is the prior day's body. The midpoint would fall somewhere here, okay? And we have a close here, all right, that is above this midpoint. And this is a bullish close, and just like with the previous pattern, the dark cloud cover, this causes many people to change their positions, and this signals a reversal in the trend. Alright, so these Japanese candlestick patterns, so the dark cloud cover and the piercing line, are both reversal patterns that are fairly similar to one another. One is just the opposite of the other, and they both signal a change in the trend based on the next day's candlestick moving in the other direction and closing above the midpoint of the previous day's candlestick. Alright, that's essentially what we need to look out for. So we can look out for these patterns, you know, if we draw a chart, most charting tools allow you to draw Japanese candlesticks. We can then look for these patterns. Alright, let's go on now to the next one. Reversal patterns, evening star. The next pattern we will talk about is called the evening star. This is also a reversal pattern. This is slightly more complicated than the previous ones because now we have 3 candlesticks that we need to look at instead of 2. So how does this pattern work? Well, this is following, first thing we need to know, following an uptrend. So we start with an uptrend here, 3 candlesticks going up all the way up to this one. Following an uptrend, we have a long light candlestick. That is this candlestick here. Okay, a long light candlestick. And now this becomes, the next part is quite important. So following this, we have an open. So we have the close here, right, of this candlestick. We have the open above the close of the previous day. So the open is going to be all the way up here now. And the price ends up closing slightly lower. So we see a slight fall in the price. You can see this candlestick is much shorter. It's like a square almost. So we have an open above the close and a slight fall in price on this day. Alright, the following day we have an open below the previous day's close. That is, this open is below this previous day's close, and a close below the midpoint of the first day's body. So this is the first day's body, this is our midpoint. The close here is below this midpoint. So this is 3 3 candlesticks, and together this makes the bearish pattern. The pattern is now complete. This signals a reversal. Because we started with an uptrend, it would mean a future downtrend. Okay, now what's important to know about this is that we have this small candlestick here. So it's essentially the same thing as the previous pattern. Alright, it's the same thing as the dark cloud cover, the first pattern we discussed. The only difference is this middle candlestick here. This is called a star candlestick in Japanese candlesticks. Star usually means when the body of the candlestick is higher than the previous days. So the close is higher than, the open is higher and the close are higher than the previous day's open or close. And we have a star here, and this is called the evening star because then the prices go the other way, come down. And again, the same condition of closing below the midpoint of the first day's body applies here. Reversal patterns, morning star. This is the last and final reversal pattern we will discuss. After this, we will move on to look at a couple of continuation patterns. Now, the morning star pattern is a bullish reversal pattern, and it is the exact opposite of the evening star. So just like we had the dark cloud cover and the piercing line as opposites, we have the evening star and the morning star as opposites as well. So this should be fairly straightforward to understand. Alright, so we have a bullish pattern here, and we start following a downtrend. So we have our downtrend here. Following the downtrend, we have a long dark candlestick, which is here. Alright, now in our long dark candlestick, we have the open here and the close is here. So the next day, we open below the close of the previous day. So we open all the way down here and end up closing slightly higher. We close over here, but still below the previous day's close. So this close here is still going to be below the previous day's close. And on the third day, we see prices open above the first day's close. So the first day's close was here, right? Prices open above it over here. Prices open above the first day's close and close above the midpoint of the first day's body. So the first day's body is here, midpoint is here. This close is above that midpoint, right? And this is the same thing that we saw in the previous pattern, except it's the other way. Once this occurs, then now this completes the pattern. Now we have a reversal in the trend. We now have a bullish pattern, and the price should go up. So one of the important things to know about these Japanese candlesticks is that the most important points are the opens and the closes. If you notice, we rarely talk about the highs and the lows. So if we're looking at the graph, these kind of this point here, this here, 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 and here. We don't really talk about the highs and the lows that much. The most important things are the open and the close. And this is generally the case for a lot of the Japanese candlestick patterns. Continuation patterns, rising 3 methods. Alright, so the next set of patterns we will talk about are continuation patterns. So as I said, continuation patterns are less common in Japanese candlesticks. So we will go through 2 continuation patterns, whereas we went through 4 reversal patterns. And these are slightly more bigger. They require a few more candlesticks, as you can see from the picture. But nonetheless, they're pretty straightforward. So let's talk about this one, the rising 3 methods continuation pattern. So we start with an uptrend. Alright, so we start with the price going up. Now keep in mind this is a continuation pattern. So following the completion of the pattern, the price should still keep going up. Right? Whereas in all the reversal patterns, we had a change in the trend. Now following the uptrend, we have a long light candlestick that's here. Alright, so this is a bullish move confirming our uptrend. Now over the next 3 days, we have small dark candlesticks. So that's 1, 2, 3 candlesticks that are small and dark. Now the most important thing to know about these candlesticks, the 3 small candlesticks, they all fit within the body of the first candlestick. So what this means is that the first candlestick, the body ranges from here, okay, to here. So these candlesticks must all fit within this body. Okay, in general, we're only interested in the bodies of these 3 candlesticks. The highs and the lows are not as important. So these 3 candlesticks must fit within this here. Alright? This is known as a period of consolidation. Now the other thing to know is that here we have drawn the 3 candlesticks dark. They don't have to all be dark. We can have 2 out of 3, as it says here, or all 3 being dark. So we must have overall downward movement by having 2 out of 3 candles be dark, but we can also have all 3 candles be dark or just 2 out of 3. Now on the 5th day, prices will close at a new high. So we have this consolidation, and then we have another green candle where the prices close up here at a new high, which is higher than any of these have made. And that's essentially breaking out of this prior day's range. So we have these lines here, which are the prior day's range, and then we have an upward breakout. This breakout out of the prior day's range, that is a bullish signal, and this tells us that the uptrend will now continue. Alright, so this completes the rising 3 methods pattern. It is a bullish pattern which has a consolidation period followed by a breakout to the upside. Continuation patterns, falling 3 methods. This is now the next continuation pattern we will discuss. This is known as the falling 3 methods. It is a fairly straightforward pattern. It is essentially just the opposite of the rising 3 methods. So it'll be everything in reverse. Alright, so let's go through it. So we start with a downtrend, okay, following a downtrend, so that's going to be these 3 lines here. Following a downtrend, we have a long dark candlestick, which is this one here, okay. After this long dark candlestick, over the next 3 days, we have small light candlesticks, 3 of them, okay, that all fit within the body of the first candlestick. So same exact logic as before. We have the body of the candlestick that's here, goes this way, this to this, and all the 3 bodies of these 3 days all fit within the first candlestick's body. This is the period of consolidation. Now, like before, these can either be all green, or you could have 2 out of 3 that are green and one be dark, right? So either 2 out of 3 or all 3 candlesticks must be light. Following these 3 days, on the 5th day, prices will close at a new low down here. This is a new low, breaking out of the prior day's trading range. Alright, when the prices close at a new low, it means the pattern is complete and the downward movement continues. So the downtrend is here, and this signals a continuation of the downtrend following a period of consolidation. And that is the falling 3 methods pattern. So now this concludes what we've talked about on Japanese candlestick patterns. We'll now briefly conclude about Japanese candlesticks in general before going on to the next topic. Limitations of Japanese candlesticks. So finally, to conclude our segment on Japanese candlesticks, we'll talk about some of the limitations and also some of the other things that we can do with Japanese candlesticks. So what we have done so far is go through the common Japanese candlestick patterns. Okay, we went through 6. We went through 4 reversal patterns and 2 continuation patterns. There are actually many more. So like I said, if you are interested in learning more about Japanese candlesticks, what I would suggest is just go online and do a search for Japanese candlesticks. There are quite a few websites that will have all the different Japanese candlestick patterns and what they look like. So that can be really useful if you find this something interesting and something that works well for you. And one thing we did not talk about, which I'll just briefly mention now, are single candlestick patterns. So all the patterns we talked about involved multiple candlesticks, right? A light stick followed by a dark stick, etc. There are also some single candlestick patterns. So for example, one of these is a doji candlestick. A doji candlestick occurs where the opening and closing prices are the same. Right, so we don't really have a bar in the middle, there's just a line. And this can have different implications depending on where that line is in the rest of the pattern. So this is something worth looking up as well. Again, we don't really have too much time to talk about it, so I skipped over it. But there are single candlestick patterns that are useful, as well as the multiple candlestick patterns. The multiple ones, we went through those because those are more commonly used and a bit more relevant. Tend to be easier to give you better predictability. So let me conclude by talking about one of the limitations. Probably the most important limitation of Japanese candlesticks is that we need to have determined a prior trend. Right, so in all these reversal patterns and continuation patterns, it needed to have been the case that there was a prior trend in place, and we need to have been able to identify that trend. So these patterns only work if there was either a trend in a particular direction, either an uptrend or a downtrend. It had to be a specific one for the particular pattern to be valid. Right, so that's the most important thing to know doing candlesticks. Now, if you want to actually have a computer find patterns for you, you can do this. You need a technical analysis software for this. It's not usually available on free software. If you find it, then that's great. If you find a free software that does it, that's quite good. I don't have a free software that does it, so I would suggest, if you're interested in it, you can look up some softwares that can actually detect candlestick patterns. So it can detect morning star patterns, for example, and flag them up for you. So you can really do a lot with these Japanese candlesticks. So this now concludes our segment on Japanese candlesticks. We will now move on to time cycles. Time cycles. So now this brings us to the last topic of our lecture. I'm not going to spend too much time on time cycles. It is kind of a fairly different, separate branch of technical analysis, but I just wanted to mention it to you, tell you what it is, so that if you are interested in it, you can find out more on your own. Time cycles refers to a school of thought within technical analysis whereby time is the primary consideration. So most of the technical analysis we've done is been looking at movements of price, right? So looking at what the price is doing on the chart. Time cycles takes time to be the most important thing. So it's mostly interested in finding out when a market will move and how long it will take to get there, right? You know, when we're interested in trading, we have to know how long a market will take to get there, as well as which way it will go. Essentially, time cycles constructs different cycles that take places for the trades. So a cycle looks like a wave, right? It's a standard up and down movement on a chart which peaks and troughs. Okay? And one cycle is a length between two troughs or two peaks. Generally we use troughs, so the cycle is a length between two troughs. And a cycle will have a height as well, so how up and down it goes. And it looks like a wave, so like a sort of continuous up and down movement. That's a wave. And we can have multiple cycles taking place at the same time. So we can have a 20-day cycle, we can have a 40-day cycle. So in a 20-day cycle, there's 20 days between troughs. In a 40-day cycle, there are 40 days within troughs. Alright, now, again, if this does not seem very clear, please forgive me. It's not the simplest thing in the world. So, if you don't understand it, that's okay. We are not spending that much time on it. Essentially, we're going to have these different cycles, and we're going to combine different cycles to explain the chart movement. So let's go on to the next slide, and hopefully this will become more clear. Alright, so we have these cycles, right? So we have, let's say, a 20-day cycle, we have a 40-day cycle, we may have a 3-month cycle, and the cycles are regular, right? So they always, every time, there's a fixed amount of time between each trough. We can analyze the price movement, alright, as representing the sum of multiple cycles. Alright, now what does this mean? Well, if I had a 10-day cycle and I had a 3-month cycle, what I can do is add them up, alright, to come out with what the price is doing now. Because we know that prices don't move in perfect waves. Okay? Obviously, if it did, then, you know, trading would be very, very easy. But it does not. But really, prices represent the sum of cycles. So what we can do is decompose that price movement into different cycles. So if we decompose the price movement into the annual cycle, an intermediate cycle, a 1-month cycle, etc., then because we know the cycles are regular, we can then predict where the price will go next. So we divide cycles into different categories of length. So we have long-term cycles, which generally mean 2 or more years. We have seasonal cycles, which tend to be around 1 year. And we have intermediate cycles, which tend to be around 2 to 6 months. We have what are called trading cycles, which tend to be around 1 month. And then we have what are called alpha and beta cycles, which tend to be 2 weeks each. The names of the cycles are not important. You don't need to know them. It's just just be aware that we have different time periods of cycles which correspond to different trends, right? You can think about it as being like the major trend, the intermediate trend, etc. But rather than focusing on direction, we're mostly interested in the time frames of the movement. Now we can add cycles to trend lines. So for example, if we have an upward trend, we can add a trend line to a constant cycle, and that gives us an upward moving cycle. So our challenge when we're doing time cycle analysis is to find out what time cycles exist in a particular chart. So like I said, we have to take a price chart and we need to break it down into different cycles, right? And we can coincide these cycles to be with what we think are the major and intermediate and minor trends. And if we know these cycles, what cycles are present in the price, we can then use it to predict the next move, because the cycles will continue as before, right? And we have to be able to add them together and create what we think the price will do going forward. Now, how do we do this in practice? Well, in general, we'll use long-term cycles to influence the major trend, right? So if we're interested in taking a long or short position, we'll look at where we are on the long-term cycle. Okay, are we in an uptrend or downtrend? That is the major trend. And then we will use the short-term cycles to determine entry and exit points. All right, so it's very similar to using major trends and intermediate trends. The only difference is that we're replacing trend with cycle, right? And trend is looking at the directional movement. Cycle is looking at how long it is between movements. That's really the only difference you need to be aware of. All right, so that's the end of time cycles. We didn't spend a lot of time on it, but hopefully you have some idea of what it is. The Murphy book is in the references. There's a chapter on time cycles, which if you're more interested, you can read about it.